Financial Survival Network, helping you survive and thrive in the new economy. Go to CarrieLutz.com and sign up for 30 free micro trainings on financial survival.
$14.90 WGCH. This is Carrie Lutz. You're listening to the Financial Survival Network. If you're wondering what to do about the Dow, where gold and silver are headed, and where that leaves you, Peter Grandich has got some very definite ideas about it. Peter, how about them Giants?
Great. I do some work with them. I spend about 12 of the 16 Thursdays with them in Bible study, and it's just great to see young men, several of which I've gotten to know personally, reach the ultimate goal in their profession, their young profession, and to celebrate. I'm saddened because at the same time I had one or two good friends on the Patriots, and I know how dejected they are. But there's, like in life, there's winners and losers. But for the day anyway, this is the Giants' day, and they're enjoying their celebration.
Yeah, today, Tuesday, January 7th, they are partying down, I think, in the Meadowlands. And it's good to hear that there really are, like, decent guys, because you hear so much negative PR about athletes being little more than thugs, and these are, like, solid, good guys who, you're happy for.
Well, good news never makes it, no matter what the profession. We used to have a Channel 9 here, used to run a segment on their nightly newscast called Good News, where they only reported supposedly good news, and that was only a 3-minute segment, which left the other 27 minutes for news that wasn't so good. And unfortunately, same as in professional sports, there is a lot of bad news. There is a certain amount of players who don't live, in a good way, and that's the news that makes. But I get to see somewhere between a third and a half of all members of a team go out of their way to be good, decent human beings, and many times it's the second and third string people that are doing that. So, just know that for every bad story you hear of an athlete out there, there's a real good one. In fact, we highlighted on our blog because we got Justin Tuck involved with a boy who was suffering from cancer a few years ago in a cancer foundation I work with here in the Jersey Shore. And not only did they become friends, they exchanged bracelets, and ESPN showed the story this weekend how Justin has wore the bracelet since then, swore he'd never take it off, and there it was in the Super Bowl. So there's a lot of good things in the midst of bad, and no different from professional sports than, unfortunately, the bad that goes on Wall Street.
Right. And when we're talking about the bad that goes on Wall Street, you've kind of coined this term, the "Don't Worry, Be Happy" crowd, which I think was a song by Bobby McFerrin, if memory serves me correct. And yeah, I kind of agree with the concept that you shouldn't be dwelling on all the negative because it can really get you depressed. But on the other hand, you need to be a realist, don't you?
You do. And my coining of that for almost 10 or 15 years, first from working there and still being around it, is that there's a major tilt to not only making the cup half full at all times, but to portray everything in the best possible light. I always like to say, half jokingly but half seriously, you could throw the typical financial guy from Wall Street or girl off the top of the Empire State Building, and all the way down they'd say the same thing, hey, so far so good. And so, there is that painting of that brush, and, there is still also an element of group that constantly paints everything bearish, buy dry food and guns and cabins. So, but it's dominated the financial industry by people and journalists kind of always tilting to the positive, bullish, the market's going to rally side.
Right, and we really saw that last week's job numbers.
Oh, it was, when you take apart the job numbers, it was actually an horrific report. But you would have known that by the reporting and the comments that came out of Wall Street, and obviously the results that came from Wall Street. And that's part of what I just described, this bias. And that's why it's important to recognize that and, to try to keep a level head about things. My own opinion, quite frankly, is the market was going to rally, and it has been, and I even said it's going to continue to rally. and the rally may last another week or it may last up to another year. But the longer-term issues that face America have not changed. In fact, they've only gotten worse. And so no matter what this rally does and how far it goes, unless you're short-term oriented, meaning a year or less, in the long run, things are going to get a lot worse before they ever get really, really better.
Yeah, well, it's hard to be an optimist now, but I think there's always a choice on the part of the individual as to seeing reality and planning accordingly. And on that note, you're an individual, you have $5,000, $10,000, maybe you have $25,000, Peter. What would you do? What would you tell them to do?
Well, I put on a different bit of hat, at that point. I take off my speculative Grandich blog where I focus on very high risk, high speculative / gambling, and focus on, I think, more important issues in day-to-day life. One of the things that isn't often talked about, but I speak about it particularly in my other hat, in my other business, and that is getting out of debt or actually becoming debt-free. It's a sensation that until you experience it, especially if you've been under debt, you can't appreciate the fullness of what that reward is. So one of the things I like to work with and express to people is that, let's look at your debt situation, because whatever it is, the cost of servicing it is more than you could make savings. So, I still see people that have, 9, 14, 15% credit card debt, and they're also trying to save at the same time. And I try to explain to them that if they just pay that debt off, they made a better investment than even the market averages. And I've also seen the mental and spiritual freedom that comes from getting out of debt. So the first thing I like to always suggest to people is out. Now, if they're past that and they're out of debt, I think the mistake that investors are making, particularly here in the U.S. and in North America, I find it in Canada too, is that they're focusing their investment dollars in equities in companies whose primarily business is in the U.S. The United States, in my opinion, is no longer the engine that pulls the economic world around. It shifted to the Far East. It's being driven by China, but also India and other areas of the world. And yet I find most Americans and many Canadian portfolios that have exposure to general equities are very limited outside North America. They don't have real exposure to where growth is clearly going to, in my opinion, do much better over a much longer period of time. So I think those are two things: get out of debt, and then when you start to invest in the world. It's kind of like Great Britain was the great empire for almost 200 years, but people who saw the United States after the Depression and started to shift their focuses away from Great Britain and into the U.S. after World War II had a period of 30, 40, almost 50 years of being on the true economic engine. I think that shift now is happening and has gone over to China and India and other pockets like Brazil and some northern parts of Europe, that if we don't have exposure for general equity growth there, I think we're going to underperform over the next several years.
Right. Yeah, and the policies that the country's pursuing, the entitlement society, 7 million people on food stamps, doesn't really bode well, does it?
No, and that's an amazing thing. I still find, I live in a 55 and over community. In fact, the majority of people are 65 and over. And one of the fears I've noticed after getting to know a lot of my neighbors the last couple of years, and when they find out what I do, they have a lot of questions, is they're very concerned now about not only outliving their own assets, but what's going to happen to their children. And what they're concerned about is they realize, that one of the biggest things that's happened here that's gone unnoticed is, first of all, 80+% of America's wealth, what's left of it, is held by people 55 and over. They are the single largest voting bloc in the nation. There are more people now over 65 than under 18. And in the last several years, they've basically been hit over the head quite a lot. The first thing they were hit over the head was this Greenspan's insanity of flooding the markets and dramatically lowering interest rates lower than they should have been, cut and took away more safe income-producing investments that they could count on. They went from 6 to 8 to 9% returns that they could be pretty safe with and base their retirement on, and fell to 1 or 2%, which could no longer support them. And in fact, that helped push some of them into the more exotic things that came out, including the mortgage fiasco, and they saw a loss of principal. Then they were told and expected, but were badly to find out that stocks and home prices just don't keep going up. In fact, they can actually go down, and you could have a loss in principal. And then the last bastion that they've had up to now is really a platinum-style health insurance policy that they pay very little for, Medicare. It is, compared to most medical coverages around the world, a phenomenal program, which has, at this moment, people who are in it don't pay a large percentage to. But all that's going to change. And so we are going to face social, political, and economic issues, and there will be a battle of classes, because one of the other things that will happen, not only will the seniors not want to see these changes happen to all these entitlement programs, Social Security and Medicare, but the younger people who are going to continuously see their taxes raised higher are going to start to say, wait a minute, I'm paying X amount of dollars to have somebody that's very old get a new heart or a new this or that. I can't afford it anymore. I can't keep living. So this is a longer-term issue. It's not something that we maybe face tomorrow or even next year. But anybody that, if there's still people out there that plan for 3 to 5 to 10 years anymore, this is going to be a major issue that the United States has to face. We've already seen this a little bit in Europe and also in Japan, and we've seen some, ugly scenes of literally battle of people of ages. And so this is it's not talked about a lot. It's certainly not going to be talked about in an election year, but this is a very big concern of mine. And then, of course, the last concern is it's only a question of when, not if, that we see a very large military conflict in the Middle East. So this short-term enthusiasm, if that's what one wants to call the U.S. stock market in, could run for a few more days, a few more weeks, even several months. But longer term, I believe we're past the point of no return, and there will be much tougher times coming in America, and they're going to last a lot longer than even most people suspect at this time.
Yeah, it's interesting because some would argue that Obamacare is already the generational conflict between the young people saying, why do we pay for elderly care when a lot of it, 80% of the bill, takes place in the person's last year of life and doesn't really help that person enjoy a better quality of life. So, yeah, I totally agree that we're going to see that generational internecine, if you will. And there's a lot of other things that are taking place. But in the meantime, we've got a really good rally going in gold and silver. And it looks like the juniors are finally stepping out from their role as the investment community's red-headed stepchild, right?
Well, from your mouth to God's ears, please, because I probably suspected that's for the last 3 years when we began the new year and ended up by the end of the year disappointed. But when we began this year again, I really said only really 3 things could happen here. The juniors will finally catch up and make up some ground compared to the great gains we've seen in the overall metal prices over several years. The metal prices will come back to where the juniors are, or they'll meet somewhere in between. So 2 out of the 3 weren't going to be bad for juniors. And right now, we've had a very good start to the junior segment. They are coming off a very vicious end of the year decline that we saw. So it's understandable. Even the bears could say this is just a dead cat bounce. But one of the things I've liked what I've seen in the juniors is volume returning in all the shares, serious volume, which is suggesting to me that we're seeing more of a wider participation from institutional investors, even as we go down the food chain. So I'm quite optimistic there, and of course I remain a roaring bull on gold itself. I called it the mother of all gold bull markets. I think once again the bears will have been bloodied, as many of them came out of their foxholes in December to again announce for the upteenth time that gold bull market has ended. And I see them heading back to their foxholes, and they won't come out until we finally get above 2,000 sometime this year. So all in all, it looks very good for gold and silver. Even the base metals are off their lows, and I think some of them have made major bottoms like zinc. And so I just think the overall market for metals is good. And one of the things I've pointed out to people, and they might have been weaned in a different way on this, it felt like a few years ago people would look for the stock market to crash because somehow that would rise gold up and that would drive the mining shares higher, when in fact, when the stock market gets hit hard, so seemingly do the mining shares. So one of the things, if you do have large exposure like I do to mining shares and exploration companies, it's not a bad thing for the U.S. stock market to be stable to higher. It would probably impact us negatively if it came down hard. And since I don't expect that anytime soon, I expect the junior market could still work its way considerably higher.
Yeah, well, it had a little run last year, and that old maxim of always taking your profits, a portion of them when you have them, rather than waiting for the big kill to come, served me well. It was the first time I ever exercised the internal discipline to do that. So 2011, even though it was an awful year for the juniors, actually turned out to be okay for me. I had a nice return, and of course, if you were holding physical gold, you were up 10%. Holding silver, you were down 10% or so, but that seems to be just about all made up now. And kind of have to agree with you. It just feels like the fundamentals are kind of lining up. And today, as we're speaking, gold's up 25 and change an ounce, practically recapturing all of last week's losses on the job report, which gold, you've noticed it, I know, just happens to take a hit every time the job numbers get released. Isn't that interesting?
Yeah, it is. And, my friend Bill Murphy, he still gets upset. And I've learned to live with the, whatever we want to coin it, manipulation or what have you, because I continue to see the physical market continually to dominate it over time. We used to get hit like that and stay down for weeks, if not months. Now it's sometimes just a short of hours and no more than days. So the enemy or the perma-bear camp has lost most of its ammunition, so I don't worry, too much about that. We will, interesting point you made about taking profits last year. We will have come in May, we'll have to make a decision because it has proven to be right the last few years, particularly in the juniors, and that is sell in May and go away.
Exactly.
We hate to say this time it's different because whenever you say that, it never is. But we'll look at May and we'll see what the market has done up until then, and then take a look, because we do tend to have some seasonal weakness in both the metals and the juniors in that May to September time frame. But as of right now, it looks like the market's going to work its way higher. Yeah, and you can't, I like the sell in May go away. It usually is correct, often is, but it's correct until it isn't, right? Right.
And who's to say that this time is going to be different? So you can't blindly follow any of these rules, because eventually it'll cause you a world of hurt, because they're not always right. Just like in October, the market usually gets hit, but it could go up every now and then. And how do you know that this year is different than the others? You don't. So that's why the strategy and the discipline really comes in and really protects you from making emotionally based moves, which is what this is all about, right? Well,
yeah, that's the thing. In a book I've written and so many talks I've given, and I still see 99% of people not doing it, and that is people don't have written plans. They literally make their investments on a day-to-day emotions, and that's the worst strategy. In fact, the best spiritual strategy is hope. No matter what faith you're in, it's all based on a hope of some type. But in investing, hope is the worst investment strategy. To just simply hope things get better for you isn't going to work out, and that's why I always like to say that people should have an actual plan, and if certain things are hit or not hit, you take that action no matter what. And that's part of the reason we've become so much more volatile, because people don't have those plans. There's more people participating and more money and mechanisms now that make trading so instantaneous that's why things have become extra volatile, because people's emotions are moving their sways. usually, I mean, sometimes there's a bad news event and it just impacts it, but usually there's no reason for any particular stock or market to go down 10 or up 10 or 20% in a day. You know, most things are known. You know, there's usually an equal supply of buys and sells, always a little bit different. That's why it's up an eighth or down an eighth or so. But when you see volatility across a wide spectrum and most companies swing and volatile, it's because people are actively trading, and most of what's driving that is emotions, not, you know, sane, solid decision making.
Yeah, the whole trend towards trading rather than investing, and I guess we could talk about that for an entire show as well. So, Peter, where do we find you on the internet, and how do we get your newsletter?
Sure, it's very simple. Go to Grandich, GRANDICH.com. It's our blog. It's simple. You can visit each day, or you can sign up for an email alert, which comes out late in the evening, and it will send you each day the last 5 postings on the blog.
Yeah, and I personally try to get to it every day or every other day, or save them up, because, hey, it's free and it's coming from you, and you've got no axes to grind. You call it the way you see it, and that type of honesty and integrity in this market is a rarity and is greatly appreciated, Peter.
Well, thank you very much. It's always a pleasure to be interviewed by you.
Hey, likewise. We'll talk to you again soon.